Blackrock, the largest asset manager on this planet, came out with a new research study. They asked their quant people to find out what, mathematically speaking, is the best allocation to Bitcoin. So when you've got a portfolio of stocks and bonds and you want to add crypto to this, how much crypto should you actually have? Should it be 1%? Should it be 5%? Should it be 10%? And now make a guess what the math geniuses at BlackRock said. You can have up to 85% of your portfolio in Bitcoin. Now in this video we are going to look at this paper. The link is also down below. We're also going to look at alternative allocations that are a bit more realistic that have also been mentioned in the paper. It's interesting though that BlackRock is now putting their quants on these questions, right? What is the best allocation? Bitcoin is now seen simply just as another asset class next to stocks and next to bonds. Let's jump into the paper together. So this is the research paper, Asset Allocation with Crypto, Application of Preference for Positive Skewness. And this paper is not in a regular PDF reader here, it is in ChatPDF. So ChatPDF is an AI tool that allows you to upload PDFs and then you can chat with that PDF. So this is ChatGPT on steroids, so to speak. Now let's first start off with this positive skewness expression. What does that mean? So the way how quantitative finance people look at returns is through distributions. So there's the idea that there is some randomness to returns, right? When you've got a business and it's maybe dependent on the weather, you don't know what the weather will be in 1 year or in 2 years. You've got some randomness of how your return will actually be. And so instead of thinking of concrete numbers, as in I might make 50% in a year, quants think of it in terms of return distributions. So there's a likelihood of X% that I make above X% of return. And so usually this looks pretty much like a normal distribution, like a bell curve. Now skewness is a mathematical expression to describe how much is this bell curve potentially skewed towards one side. So it's not completely balanced, but it might have a bit more weighting on the top. That's positive skewness. In the crypto space, we tend to call these kind of investments moonshots, right? You've got a high likelihood that you lose everything, but there is some likelihood that you get massive outsized returns. So let's have a look what the research paper is saying about that skewness. And so that's the beauty of this tool, right? We don't have to read through the 43 pages. We can simply just ask it, what is the research paper stating about skewness in Bitcoin or in Bitcoin returns? Explain to a fifth grader, right? We want to make it easy. And so here we go. The research paper is talking about something called skewness in Bitcoin returns. Skewness is a fancy word that means how much the numbers are spread out in a set of data. In this case, the researchers found that Bitcoin's returns have a lot of positive skewness, which means that there are a few really positive return numbers that make the average return look higher than it really is. It's kind of like if you got a really high score on one test, but all of your other scores were just okay. That one high score would make your average score look really good, even though it's not a good representation of how you usually do. Quite simple explanation, right, of what we described before with this normal distribution. Now here are a few more questions. What is the potential return for Bitcoin going forward? The PDF doesn't provide a specific prediction for the potential return of Bitcoin going forward. However, it does mention that Bitcoin returns exhibit pronounced positive skewness with a third central moment of approximately 150% a year. Additionally, it notes that BTC has an annualized mean of 108.5 per year, which is 14 times higher than the mean of equities, which is 7.7% per year. Now, a mean of 108.5%. I want to talk about this. You've probably seen those Bitcoin regression charts, right? For example, the Bitcoin rainbow chart. If you follow this channel, you probably have seen this. You see that in the early days, Bitcoin grew very, very quickly, and there's always these ups and downs, right? There's the bull markets and the crashes, but the overall growth, right? The growth rate is slowing down with time. There's normally a curvature to the logarithmic regression, to the trend that is plotted on top of the Bitcoin price. And And that growth slows down is pretty intuitive, right? Nowadays, Bitcoin is way larger in market cap than it was in the early days. So it takes way more capital for it to double again and to double again. So Bitcoin that's at $10 is way easier to go to $20 than one that's at $10,000 and that has to go to $20,000. It's the same growth in terms of percentages, but it's not the same growth in terms of dollars. And so it is a problem to just look at historical returns of 108% per annum and extrapolate this in the future. I don't think that's the long-term growth rate of Bitcoin. I think it's rather somewhere around 30 to maybe 40% if we are lucky. But I have made separate videos on this in the past on this channel, so feel free to simply check out prior videos on the channel. I will not repeat this again in this video. Let's dive back into the research paper instead. So what would be an appropriate allocation to Bitcoin in a portfolio? According to the PDF, the appropriate allocation to Bitcoin in a portfolio depends on the investor's risk aversion and of course preferences for positive skewness. The research conducted shows that a power utility investor starting from a 60-40 equity bond portfolio would wish to allocate 85% of their portfolio to Bitcoin holding. The remaining 15% of their portfolio in the same fixed 60-40 equity bond mix. Isn't that super impressive? The math guys at the largest asset manager in the world says 85% of your portfolio could be in Bitcoin. Here, let's look at the source. Page number 3. At the calibrated point estimate of the mixture of normal distribution fitted to historical data, a power utility investor starting from a 60-40 bond portfolio would wish to allocate 85% of their portfolio to Bitcoin, holding the remaining 15% of their portfolio in the same fixed 60-40 equity bond mix. We show that this is theoretically driven by the enormous third central moment of the Bitcoin distribution, which is well captured by the Bliss regime. Even when we set the mean of the normal regime distribution to correspond to a loss of 50% in the price of Bitcoin, a 2 or 3% allocation to Bitcoin favored by Petafy or Dalio can be justified by small probabilities of 0.005 or 0.019 respectively of the Bliss regime occurring. Now this is obviously unrealistic, right? Math might say historically it would have been the right thing, but we all know that the future performance won't be the same as the past performance. This is in general a problem I have a lot with those traditional finance quant guys. They very often extrapolate the future returns based on the past returns. So when you also have the Markowitz portfolio allocation, for example, people think, okay, this is historically the volatility of that asset, this is the return of that asset, and so let's find the optimal weight based on those, right, to find the best risk-adjusted return for a combined portfolio. But very often future returns are nowhere near past returns, and past returns are a pretty bad predictor of future returns. The Bitcoin returns, for example, they decrease over time as we see with the logarithmic regressions. So what's more realistic? What's a more realistic allocation? So I asked ChatPDF, is there an alternative, more realistic allocation? Yes, the PDF mentions alternative allocations to Bitcoin that may be more appropriate for some investors. For example, Thomas Petafy, the founder of Interactive Brokers, advocates for holding 2 to 3% of one's wealth in cryptocurrencies. Ray Dalio, the founder of Bridgewater Associates, believes that an allocation of 1 to 2% to BTC are reasonable. Additionally, and here it comes, the research conducted shows that starting at a 2080 stock bond portfolio leads to a 12.5% Bitcoin allocation. And a risk-tolerant investor with an 80-20 bond portfolio desires a levered position of Bitcoin of 106.6%. So the numbers are all over the place. What could this mean? In the end, investing is way more psychology than math. Even though math is a useful tool, most of the time the issue is that you have to follow through with whatever strategy you derive from the math. And even if you use different approaches to math, the results are vastly different, right? Some people say 1 to 2%. Other people say you should go on with a leverage, right, of 103%. Some people say you should have an 85% allocation, others then 12.5. So the numbers are everywhere basically. So what should we really follow? I think a good measure psychologically is to look at historical drawdowns and make this as the worst case scenario. The drawdowns in Bitcoin also tend to go less over time. So in the early days we had 90% drops from the all-time high. Nowadays we rather have 70% drops. So this does come down, the volatility does come down. But think of it this way, right? When you've got a certain allocation to Bitcoin, say 50% of your portfolio, which in my opinion is too high, right? But if you've got half of your money in Bitcoin and you would see another 70% drop, would you be okay with that? So would you be okay to lose, say, 35% of your wealth in a single drop? And could you potentially double down on that, right? Could you buy more when Bitcoin drops? Because that's in the end the whole idea, right? When there's volatility and goes temporarily against you, do you have the courage, the strength to take advantage of those low prices? If the answer is no, and you think psychologically the drop is too high for me to double down during such times, then that allocation is too high. If, however, you allocate maybe 10% of your overall portfolio and then it goes down 70% and then you lose 7% of your portfolio overall, could you then double down? Could you then sell some more of your stock and your bond in order to buy more Bitcoin? That would be way easier psychologically, right? So don't imitate the mistakes that a lot of quant people in finance do. Simply do what your psychology tells you. Take as much risk as you feel comfortable with. Because if you do get uncomfortable through any point in time during your investment journey, then you will simply just give up the strategy and then all the math gets out of the window. I've got one more thing, so let's go back to the screen. So if you like this video, please give this a thumbs up to help spread the word. And if you haven't subscribed yet, feel free to do so as well. I publish videos here regularly. Last but not least, there's also a Telegram channel. Simply search for Bitcoin Strategy Channel within the Telegram app or click the link down below. I hang around there regularly. Looking forward to chatting with you. Bye-bye.